This is Matthew Cratter from Trade University, and today I want to talk about the Fed pressing the reboot button. There's been a lot of talk about the Fed in the wake of yesterday's meeting and the 75 basis point hike, but I think there's a much bigger thing going on here that you should be aware of because it's going to affect your money and your finances and, in fact, the fate of whole countries over the coming years. We're going to be talking about what I'm calling the Great Monetary Reset. So there's a misconception that the current Fed is facing this choice between high inflation and recession. And I think that's true, but it's actually much worse than that when you look at the numbers. So we have total government debt, federal debt, at $30.5 trillion. You can see that this is a chart that just goes up. We have inflation, CPI inflation, the latest reading was at 8.6%. Now, the normal way to fight inflation, and bear with me through this because you're going to be amazed by the conclusion, but to get there we have to do a little math. CPI inflation, 8.6%. Normal way to fight inflation is to get Fed funds and other interest rates, for example, the 2-year and the 5-year and the 10-year Treasury yields, get those above CPI. In other words, have positive real rates for the whole U.S. yield curve. A real interest rate is just you take the nominal interest rate and you subtract the rate of inflation. So this gives you your real return after adjusting for inflation. So if we think of it in these terms, Fed funds, which are the really short-term interest rates that are actually set by the Fed, they're still massively negative. They're currently trading at a range of 150 to 175, 1.75%. Inflation is, at the government's estimate, 8.6%. It's actually much higher than this if you don't use government massage numbers. But even using their massage numbers and their bizarre accounting, we end up with massively negative real interest rates, minus 6.85% at the front end of the curve. So real rates are still massively negative. They haven't been this negative since the years following World War II in the U.S. Now, you normally need positive real rates to stop inflation. In other words, if inflation is at 8.6%, as the CPI is, this means you need to get Fed funds and other Treasury yields above that hurdle rate, that inflation rate of 8.6%. So let's just do a quick thought experiment and calculation to see what would happen if we got interest rates that high in the U.S. So the U.S. government has $30.5 trillion worth of debt. This doesn't count all the Social Security and Medicare future liabilities, the entitlement liabilities, but we're going to use this really small number. And I think when you add in Social Security and Medicare, you get close to 80 trillion. But even if you just use the 30 trillion number at an 8.6% interest rate, the annual interest on that debt is 2.6 trillion. These are annual interest payments, not just paying back the principal, which usually doesn't get paid back because the government debt is rolled. You issue new debt to pay off old debt. But this would just be the annual interest payments. To put that in perspective, the current interest on federal debt, the current interest payments are 0.4 trillion, 0.436 trillion. This is the government, the payments to service the debt, the federal debt. So that would be an increase in interest payments of 2.16 trillion. To put that in perspective, the current U.S. federal budget deficit, the actual deficit, is close to $2 trillion. So you'd be more than doubling the budget deficit. This is when tax revenues only at $4 trillion. So this would be quite devastating. It would totally blow out the budget deficits, and ultimately the government would need to issue more debt in order to plug the gap, unless you could have tax revenues massively rise for some reason. So again, this calculation, we're using 30.5 trillion. This doesn't even count the additional debt that we know will need to be added to pay out Social Security and Medicare over the coming 5 to 10 years. The other problem, the other thing that this calculation did not take into account was at those interest rates, at 8% interest rates, tax revenues plummet even more. In other words, government revenues plummet because stocks are down another 40 or 75% from here. Housing is down 20, 30, 40% from here. And so the government, as we said, would need to borrow even more money to make up for falling tax revenue. So it's much worse for Powell and the Fed. It's not a choice between inflation and a recession. It's a choice between something much worse. It's a choice between very high inflation, which we've been having, and federal government insolvency, where the government reaches a point where it cannot make the interest payments on its debt. This would be a default of the largest government in the world and the world reserve currency issuer. You cannot have the world reserve currency issuer default on its debt. Everything is pinned to treasury rates. Everything is related to the dollar. If the U.S. ever defaulted on its debt, you would end up with complete global chaos, famine, the cessation of trade, and probably a world war. So this is the real choice for the Fed. It's very high inflation or government insolvency and a default by the U.S. government. So what is the Fed to do? The real problem here, as we've seen with this thought experiment, is the Fed cannot hike interest rates very much with this much debt in the system. We've talked about this many times. Debt peaked. This is a debt to GDP, so normalizing debt to the size of the economy. And the reason we look at this ratio is because it's the real economy that is needed, that is used to service the debt. If the economy is big enough, if it generates enough tax revenue, then the government can service the debt. But once you get debt to GDP levels above 120%, this is where very few countries have gone, and the countries that have gone there have always ended up defaulting. Once you get to these levels, things become very difficult. It becomes very difficult to raise interest rates at all, as we're seeing, because it completely tanks the asset. It tanks asset prices, stock prices, crypto prices, housing prices, and bond prices as well. So we have these very high debt levels. This is why even small moves by the Fed have a huge effect, and why jawboning by the Fed, talking about what they're going to do with interest rates, has a huge effect as well. Everyone who says we need to bring back Paul Volcker, this is what a lot of people over the age of 60, you hear them saying, because they remember the reign of Paul Volcker in the 80s, when he brought down, in the late 70s, early 80s, when he broke the back of inflation. Debt to GDP levels back then were at 30%, 30%, 31%. They're much, much lower. Paul Volcker himself, with all of his resolve and stubbornness and independence, could not raise interest rates like he did in the 80s if he were to come back today and try to do it. So the real thing that needs to be done before we can raise interest rates and normalize policy is to get these debt to GDP levels down massively. We need to bring down debt to GDP levels down to something approximately half where they are now. It'd be nice to get them down to 30%, but if we could even get them down to 60%, that would be a big improvement. And that would just be bringing us back to where we were in the late 90s and the early 2000s. So that would be a level to target. Now, how exactly do you bring down debt to GDP levels? To do this, you need to either pay down the debt, in other words, pay off the debt in the same way that you would pay off a credit card bill or a mortgage that you had taken out. You need to actually pay down principal. You can't just make interest payments. You have to pay down the actual money you've borrowed. And this can only be done by government running huge budget surpluses. There is no sign that we will have budget surpluses anytime soon. We only had them for a very short time under Clinton in the late 90s and early 2000. So there's no reason to believe that this will come back again, especially when tax revenues are plummeting and asset values are plummeting. So it's too difficult to bring down debt levels by paying off the debt. And the U.S. government has never paid off its debt except for that very short time period in the late 90s, early 2000. Instead, they issue more debt to pay off old debt. So the only way you can really bring down debt to GDP levels, because you can't bring down the numerator, you need to increase the denominator. You need GDP growth. You need to grow the size of the whole economy. You need to increase gross domestic product, which is just the sum of all the goods and services that are sold in the economy. One way to do this would be to have an amazing technological innovation. If we came up with nuclear fusion, if we made that affordable and safe, that would be one thing, because you'd have very cheap energy. We could imagine a technology like teleportation technology, like on Star Trek or something like that, where you don't need to take airplanes or cars anymore. You can teleport around the world. This could result in much higher economic productivity. You can imagine what the average worker could do if they could zap themselves around the world. This is a little bit of a funny example, but this is an example of how radical a technological innovation would need to be in order to increase GDP a lot. And we need it to happen really soon. And so it's hard to know. I don't think there's anything like this in the pipeline that's going to happen very soon. So what are we going to do? we cannot pay off debt. We cannot increase GDP by increasing real GDP. In other words, making the economy more productive through technological innovation. The only way out is to increase GDP by having very high inflation. This is another way you can increase nominal GDP, because nominal GDP is just real GDP plus some inflation factor. So let's say that we increase GDP by doubling the price of goods and services in the economy. So if you normally pay $30 for a haircut, it's going to be $60. If you pay $6 for gas at the pump, it's now going to be $12. If a house costs $400,000, it goes to $800,000. The price of everything doubles. Now, this would double GDP. In other words, if we had 100% inflation for 1 year, GDP, nominal GDP, would roughly double. This would mean that these debt to GDP levels would fall from 120% to 60%, simply because we have the denominator here and we're doubling the denominator, so that halves the whole ratio. We'd have debt to GDP levels fall back down to where they were in the late 90s and early 2000s. At that point, the economy would no longer be quite as levered. We could actually raise interest rates without blowing up the economy or do anything that the Fed wanted. So that would bring us back down here to 60% GDP levels. What is doubling GDP through very high inflation like this? In other words, 100% inflation. You could do 100% inflation in 1 year. You could call it 50% inflation in 2 subsequent years, or slightly less than 50% inflation, something like this. This is the same. When you have inflation, it's another way of saying that the currency is losing purchasing power. Doubling GDP through this kind of basically almost hyperinflation would be a giant devaluation of the US dollar. It'd be a giant currency devaluation, as we've seen happen with many currencies over time. Venezuela and Turkey and Lebanon and Argentina and Thailand in the late 90s, etc. So what you could do is you could get all the central bankers of the world could get together and devalue their currency simultaneously against real things. Or if the U.S. did this, it would have enough ripple effects that you wouldn't really need to have China and Russia on board, for example, but you could have most of the G20 nations on board. You would have this giant currency devaluation of all the fiat currencies, especially the U.S. dollar. Global debt to GDP levels would plummet simply because GDP levels would be doubling around the world. This would be a form of a monetary reset, where you're basically resetting the system and you're bringing down debt to GDP levels and giving the system a fresh start without having to, let's say, hang the central bankers. What would happen under this scenario? Stocks would double or triple from current levels, maybe quadruple. Gold would be at 5,000, 7,000, 8,000 would be my estimate. Bitcoin would easily be at 500,000 if something like this happened. Bitcoin is such a small market, it's so illiquid that the price of it is really set by the marginal buyer and seller. And if you had a reset like this, it would more than 10x Bitcoin. Maybe I'm being too conservative here. Maybe it would hit $1 million. So I think the Fed has a choice and central bankers have a choice. They could do something like this, take the pain and get it over with. Or we can do what the Fed is doing now, because Jerome Powell is such a cowardly person. He's a lawyer, an investment banker, and a private equity guy who's never really done anything real. And he's more of a political figure, as Fed chairmen are. And so what we have the Fed doing, and what they did yesterday was a perfect example, is they talked a really tough game, and then toward the end of the press conference, Powell became a little bit more dovish, and that's why we had such a big stock market rally yesterday. So what we have here is the Fed slamming on the brakes, taking them off, slamming them on the accelerator, slamming them on the brakes again. And that's why you have these days where the Dow is up 1,000 points and down 1,000 points, and these can be days right in a row. You have Jerome Powell talking out of both sides of his mouth, really lost and not knowing what to do. And so it's a little bit like jumping in a really cold lake. You can do it very slowly in a very painful way, or you can do it all at once. You can just jump off the dock, get in the lake, and your body resets quickly. It's the same way pulling off a bandaid, and maybe that's a better metaphor here. We have this terrible bandaid that the Fed has been building up over the last 50 years. We can tear off the bandaid quickly, or we can tear it off slowly. And so far, it looks like the Fed wants to do it slowly, and that's why we have so much volatility. That's why there's so much pain in the economy, and that's why we have days where the Dow and the NASDAQ are up hundreds of points and then down hundreds of points just the next day, as the economy lurches between inflation and deflation and just trying to process where interest rates are going. Now, at this point, I can hear some of you saying this is a complete fantasy. This could never happen. This is just an academic exercise. But in fact, these kind of monetary devaluations, these kind of monetary resets happen all the time, and they've even happened in the U.S. This happened in 1933 with the famous Executive Order 6102, where President Franklin Roosevelt basically made the private holding of gold by individuals illegal, with some small allowance for tiny pieces of jewelry, but you could not hold gold as a monetary asset or as a savings device, at least above a certain level. And what happened is the banks, where most of the gold was being held, even though it was being held in your name, what happened is the bank stole it from you. They paid you $20.60 per ounce for your gold, and they took all the gold, they put it in Fort Knox, and then they revalued gold to $35 an ounce. So this was when the U.S. dollar was backed by gold, but this was basically essentially a huge currency devaluation, and this is one way that the U.S. was able to get out of the Great Depression combined with World War II. So this is a great example of a monetary reset that happened approximately 100 years ago, which is why it's not on everyone's radar. But this is something similar, where you basically devalue the purchasing power of the currency in order to eliminate debt and do a monetary reset. I think this is the end game that we're currently in, and it's unclear whether we're going to go there quickly, whether there'll just be one weekend when things get really bad, and we get the news Sunday night, right as the futures markets are beginning to open, that everything has been revalued, that there's been a massive currency devaluation of the U.S. dollar and all the fiat currencies around the world overnight. And what you would do this currency reset, and then you would massively raise interest rates at the same time. This would be something that could happen if things get more dire than they already are, and things can obviously get a lot worse than they are now. The alternative is this ridiculous bouncing from wall to wall, and Jerome Powell talking out of both sides of his mouth. But I do believe that this is the decade of the great monetary reset, and the best place to hide from it is obviously stocks, housing, and of course Bitcoin. Bitcoin is the best place to hide from it. And I think this is what's coming. We're either going to have a very quick monetary reset one of these days or one of these years, or we're going to have a slow motion reset as we're having now, where we have this very high inflation and the debt-to-GDP levels are coming down. They're coming down fairly slowly and very painfully. There are a lot of political implications for this. This implies that a lot of incumbents, including Biden himself, are not electable in the next cycle because people are going to be very mad about what's happened. So there would be political pressure to, at some level, to pull the Band-Aid off and get this monetary reset over with as quickly as possible. Either way, Bitcoin is obviously the best place to hide your wealth. If you wake up, if you go to sleep on a Saturday night and then you wake up on a Sunday and everything's been revalued, your purchasing power, if you have $20,000 in your savings account of US dollars, all of a sudden its purchasing power goes down to 10,000, and everyone takes this hit simultaneously. It's only if you own assets, actual assets like real estate or stocks or Bitcoin, that you can be protected from this sort of thing. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video, and let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.